Welcome, everybody, to the Jennifer and Merrill Show. Merrill and Jennifer here with you, bringing you myth-busting insider secrets and the big questions that Jennifer, in all of her travels, at real estate investor, real estate agent, just entrepreneur extraordinaire, all the things you run into, Jennifer. It's so fascinating, the questions that come to you, and we get to consolidate them all right here and bust them out. So what's going on out there? Where have you been most recently, and who's asking what?
So I've got to tell you, real estate investors, of course, have been looking at this market, and they're starting to figure out where do I put my money, where do I not. And I've had a lot of sellers who have been selling their houses, and they've been looking at what are their options. Should they rent? Should they buy? But also the number one question, that's why we have to do myth busting this week, is for people who are sitting in their home and they're like, my home keeps going up and up and up and up in value. They just see all that money. It's just like this piggy bank that just, it's money burning a hole in their pocket. And so the number one thing, of course, that people constantly ask me is, should I get a line of equity on my home since the value's gone up and pay off my car?
Yeah. Okay.
Help!
All right.
Help!
Yeah. So a couple of things here. First of all, and I've heard similar things. People are asking about, like, hey, I want to do a cash out refi. I've looked at the numbers. I can make a payment on the new amount of my mortgage, and I can get all this cash into my hot little hand, right? So the idea. So let's deconstruct this a little bit, because there are some nuances we need to be careful of. First of all, if you do a cash out refi, don't go past 20% or 80% of the current value of the home, because most people, not everybody, but most people in the reset in 2008 went underwater if their equity, or if their mortgage note was 80% or higher. So they got stuck, and we had to wait years for our appreciation to get past that. So now the good news about that is interest rates are going up. And so the lower interest rate you have, this money is sealed at that interest rate. Just don't go above 80% if you're going to do a cash out refi and take all that money, because your interest rate will freeze at whatever it is, 4.5%. It's going to climb some more. We don't know how long it's going to last, because the Fed is really intent on stopping this inflation. So it may spike for a minute and then plane out, and then over the next couple of years we may have a decline again. But if you got to have money, don't go above 80%, just so you don't end up upside down, unless it's worse than 2008. Unlikely, but unless it's worse than 2008, 80% loan to value is probably safe. Now, for those of you who don't know how to deploy, because what are you going to spend that money on? Let's address the issue about paying off other debt. Remember, we do not want short-term gains for long-term losses. We don't want to cut off our nose to spite our face. And what do I mean by that? So if we are going to pay off debt, we want to lower our credit cards, because the amount of money that you have, as long as you have the discipline not to charge them back up. If you're going to charge them back up, just keep them high and pay them low, and suffer and punish yourself with high interest rates. But if you can pay them down and not use them, or go to the boot camp and learn how to use them well, and learn the tools you need to be successful as a borrower, that revolving account debt is awesome to pay down. Auto loans are extremely low interest. We're asking about the cost of money. So you want to evaluate how much. Let's say you get $100,000 in a refinance. You pull the money out. You got $100,000. What can you make with the $100,000 versus using 5, 10, 20, 30,000 of it to pay off a 3% interest card? We stop trying to clean up your life. Organize your life so that this 3% interest, 4% interest automobile, you don't spend 5 to 30 grand to pay it off. Use that 5 to 30 grand to invest in something that's going to make you money. Leverage these cheap dollars, because remember, if interest rates go up, getting a new mortgage or a refinance is going to, they're going to be cheap dollars and they're going to be more expensive later. So get the money now, but invest it intelligently. Don't pay off. Plus, need we say, FICO has a placeholder, lender software, when they're evaluating you for credit. You're going to lose 10 to 15, maybe 20 points if you pay off your auto loan and you pay off the only auto loan you have. You're going to lose 10 to 20 points because there's what we call placeholder points, because FICO and lender underwriting evaluate your risk. If you have a mortgage and you have an auto loan, you, in their eyes and in their calculations, their predictive software, you're the least likely to lose them money, lose a lender's money. The second you start giving those placeholders up and you pay them off, your score is going to go down because they don't want to give you money because they don't trust, hey, now they're just one of these bohemians that only have a credit card and they're traveling the world. I can't trust them with my money. And so you're going to lose long-term benefit. So don't pay off your car, especially since all of our cars are so low cost in interest rate. Invest that money. Now, the next stop, that's for cash out refis. Now, let's ask the question about the money's a little more expensive, but HELOCs. What if we got a home equity line of credit so we can tap that same 80%? Don't go higher, but you could go higher as long as you don't use it, because they'll lower the limit on that HELOC, that home equity line of credit, back down to the value of the home if homes lose their value. So if get as much as you want, but don't use above 80%. Now, so the rules are the same there, how much, what the loan to value is. Now, HELOC money is a little more expensive money, 0.5 point, 0.75 point. But you don't have to take it all out at once. You can pay down your credit card debt, and now you're paying with 4.5%, 5.5% interest money, 20 and 22% credit card debt. So that's smart. That makes a lot of difference. But you don't have to deploy the capital all at once like you would if you did a cash out refi. You got to put that money somewhere. What are you going to do? Put it in your mattress, right? It's going to lose value with inflation. So get it into assets and invest, as we said. With a home equity line of credit, pure genius. You can now write a check and do deals as they come to you. Now, as the interest rates creep up, so do home equity rates creep up. But it's still, if you're going to do a fix and flip, if you're going to invest into dare I say crypto, do safe real estate bets, guys, or equity positions in companies that are killing it. But now you can spend money as you see the opportunity, and your home equity line will grow up. They usually charge either the next month, next quarter, or within 6 months. The rates will change to follow what your the current prime interest rate. So be careful, but at least you're not grabbing money and you have a super high mortgage now. Your mortgage stays the same from your original first, but you're tapping the equity with this home equity line of credit, and then you just use it and pay it off, use it and pay it off. It's a sweet deal. Costs a little more, but the versatility is amazing. So
let's recap that really quick. So number one, you don't want to ever pay off your only auto loan, right?
Never. Not if you want credit in the future, you guys. It's a 10 to 20 point drop in your score, but your fundability plummets straight up. Right. You are less trustworthy as a borrower without one mortgage and without one auto loan.
So that's number one. Number two, if you have really high interest rate on your credit cards, and again, like you had said, if you have high balances and you can be trustworthy, then pay them off with the line of equity, only again if you're not going to breach that 80%.
Yeah, be careful there. Yeah,
That's a really important one. Now, let me throw one more monkey wrench in before we run off today. And that is for people who have student loans. As you probably know, student loans have been cited in so many different, I don't have one readily available, but there's so many sightings that is the number one thing that's preventing many new first-time home buyers from actually purchasing a home.
Yeah.
So their parents are thinking, oh, I should pull out the money so that I can pay off their child's student loans. So what do you say here?
All right. So now we get a little, we're always going to go with the cost of funds, right?
Yeah.
So right now, your student loans do not move. Whatever you engage them at, whether it's 3%, 5%, some might be 8%, but it is frozen. So that's the cost of the money. And that's what I always go back to is how much is your money costing? If I lived through the 80s when interest rates just were 13 and 15%, you guys.
Right.
So right now, all student loans are in moratorium. So don't pay a damn thing, right? They're in moratorium, and they keep extending that because the current administration promised to do something to alleviate all of this pain and suffering, because the cost of education is so high, and the cost to get all of these loans to pay for education is so high, yet the job market is, people are leaving these highly specialized education frameworks and coming, and bartending or, working at Hertz Rent-A-Car. I mean, these are just some of my clients that I'm talking about. So even 5%, 8% student loans is still less expensive money. Can you make 8% with that? Let's say you got that $100,000 cash out refi or HELOC. So we're talking to the parents now of these students. Can you invest in something that's going to pay 8% so that the dividend and if you there's some passive investments that are bulletproof, you guys, especially in the current real estate market. Syndications are paying anywhere between 15 and 18%.
Yeah.
And talk to Jennifer if you want some intel on all this, right? But the bottom line is that do not pay leverageable money to pay off low-cost debt.
Right.
Do not wait, because you only have the $100,000, folks. What do we do? You can make at least $8,000 and then take that money and pay off the student loan. If you want to pay your kid's loan off, too many of us don't know how to deal with our psychic drag of, how many of us have thought of, if I could just wrap if I can wrap all these credit cards into one simple loan, right? And right. Now that might be a good deal for your particular situation. It might crush the soul depending on the service that you use. Be very careful about these minefields. So if the money is in deferment and it's low cost, be very, very careful about just thinking, let's just pay it off. Invest where you can, because that money can be spent once on paying off debt. It can be spent dozens of times if you are investing it.
Yes.
And return on your investment.
Oh, thank you. That is just the question. And again, those are some basics. And I want to call them myth busting, because, there's some of the, I want to say, talking heads, those people that they look up to, and even just fixed ideas that people have had their whole life. Oh, I got to pay off my car payment. I've got to pay off my...
Get out of debt.
Yeah.
No, there is consumer debt, you guys, and then there is a strategic debt. And and some people buy they buy packages on learning how to invest, learn how to do real estate. That might be a far better educational platform than even going for a bachelor's degree, right? So we want leverage. It's all about leverage. And as always, Jennifer, it is amazing. So if you want deep dive intel into all of this, get getfundablejennifer.com, getfundablejennifer.com. Come and see exactly all of these strategies. Yeah, we're like,
where is the number?
All of these strategies, because we're just barely doing the surface on all this stuff, and we want you to be able to make the best decisions that's going to leverage the opportunities you have right now. We've had high appreciation, but the interest rates are going up. How do we navigate that? We will see you
next week,
time.
right?
Absolutely, next time. All right, you guys have an amazing day and week, and we will catch you. I want to make sure. Yes, next week. The week after, I'm at FICO World, so it'll be catch as catch can. Next 2 weeks, FICO World.
Wow.
Yeah. All right. Oh, and I'm going to be in Orlando, so I don't know where you are.
Oh, maybe I should pop over and say hi.
That would be awesome. It would be. We could do even something live and in person.
We should do it live in person that week. Oh my gosh, definitely. Let's do that, because I'm really close. I'm like an hour and a half away. It'd be easy to get over there.
All right,
let's do it.
That would be awesome.
Yay!
I love it. Thank you, and everybody have a great week. We'll see you next time.